In the realm of finance and politics, the interplay between presidential rhetoric and stock market performance has sparked widespread debate and scrutiny. The assertion that the leadership of a single individual, such as the President of the United States, can dramatically influence the trajectory of the stock market is a topic of considerable interest and controversy. Welcome to Stock Whispers, your gateway to investment brilliance. Today, we will dive into the fascinating world of stock market claims, particularly focusing on the bold assertions made by political figures about their impact on market performance. Our episode is inspired by a letter from Mike Scanlon, which brings to light some bold claims made by Donald Trump regarding the stock market during and after his presidency. Trump often linked the stock market's rise to his policies and leadership. He warned of catastrophic crashes tied to his impeachment and the potential election of Joe Biden. However, the data tells a different story. Let's dive into the numbers and see what really happened, shall we? During Trump's presidency, particularly at the time of his first impeachment, he suggested that the stock market, which was then around 27,000 points, would plummet if he was impeached. Yet, the anticipated crash never materialized. Similarly, leading up to the 2020 election, with the Dow Jones Industrial Average around 29,000 points, Trump posited that a victory for Joe Biden would lead to a market crash. Contrary to his predictions, not only did the market not crash, but it has also since surged past 38,000 points under Biden's administration. These instances highlight a fundamental truth about the stock market. Its movements are influenced by a myriad of factors, not just presidential politics. While policies can have an impact, the market responds to a complex web of global economic trends, corporate earnings, interest rates, and investor sentiment, to name a few. Let's break down these factors to understand how they interplay to shape market outcomes. Imagine the stock market as a huge ocean where waves can grow big or stay calm, pushed by winds from all sides. These winds are like different forces that move the stock market. Some of these forces include economic indicators, which are signs showing how the economy is doing, changes in government policies, big events happening around the world, and how well companies are performing. For example, when a company says it's making more money than expected, people often want to buy its stock, which makes the stock price go up. This is because people think that the company is doing well and they want to be part of its success. On the other hand, there are signs that tell us about the health of the whole economy, like the unemployment rate and how much money people are spending. When fewer people are out of work and families are spending more money, it shows that the economy is strong. This makes investors feel good about the future, so they're more likely to invest in the stock market, which generally causes it to go up. These examples show how the stock market responds to different kinds of news and events. Just like the ocean reacts to the wind, the stock market reacts to what's happening in the economy and the world, moving up and down based on these changes. When we take a step back and look at the big picture of the stock market over the years, we notice something interesting. No matter if the president is from the Republican Party or the Democratic Party, the stock market has had its good times and its bad times. This tells us that the ups and downs of the stock market aren't just about who lives in the White House. There's a lot more going on behind the scenes. Things like economic cycles, which are the natural rises and falls of the economy over time, the creation of new technologies, and events happening around the world all have a big impact on how the stock market performs. For example, when new technologies are invented, they can completely change how we live and work, leading to growth in the stock market as new industries develop and expand. On the other hand, when there's trouble in other parts of the world, like conflicts or economic problems, it can make investors nervous and cause the stock market to drop. These factors show us that the stock market is influenced by a wide range of events and trends, not just by who is the president. Understanding this helps us see the stock market's movements as part of a bigger, more complex system that is affected by a mix of domestic and international events. Another crucial factor is investor sentiment. It's like the mood of all the people who are buying and selling stocks. Just like how a piece of good or bad news can make us feel happy or sad, different kinds of information can make investors feel optimistic or pessimistic about the future of the stock market. This includes news stories, gossip that spreads, and yes, even what's happening in politics. When investors hear something that makes them think the market will go up, they're likely to buy more stocks, which can actually push the market up. But if they hear something worrying, they might sell their stocks to avoid losing money, which can make the market drop. The tricky thing about investor sentiment is that it can change very quickly and is often based on how people feel rather than solid facts. For instance, a rumor about a company might make investors sell their stocks in that company even if the rumor isn't true. Similarly, if investors think the economy will do poorly in the future, they might start selling off their stocks, causing the market to fall, even if the current economic data is strong. This shows how powerful investor sentiment can be, influencing the market in big ways based on what investors believe will happen, not just on what is actually happening. Now, let's debunk a myth. Some people think that one big event or the person who is president can control how well the stock market does. This belief is too simple and doesn't capture the whole picture. For example, Donald Trump often said that the stock market's success was closely linked to his actions and what happened to him politically. But the truth is, the stock market is influenced by many different things, not just one event or one person, no matter how powerful they might seem. The stock market has shown time and time again that it can bounce back and grow, even when things are unsure. This ability to recover and expand during tough times highlights how complicated and resilient the stock market really is. The stock market's complexity comes from its sensitivity to a mix of factors, including the health of the global economy, changes in technology, and the confidence of investors, to name just a few. While political events and decisions made by presidents can affect the market, they are just one part of a much larger puzzle. The market's performance over time reflects its response to a combination of these influences, rather than following a simple cause and effect pattern linked to a single event or presidency. This understanding helps us appreciate the stock market's dynamic nature, reminding us that it operates within a vast and interconnected system of global and local factors. Navigating the stock market can seem daunting due to its complex nature, with its ups and downs influenced by a myriad of factors. However, by adopting some tried and true strategies, individuals can make more informed decisions and potentially increase their chances of investment success. The first strategy is diversification, which means spreading your investments across various sectors and types of assets. This approach is akin to not putting all your eggs in one basket. By investing in a range of areas, you reduce the risk that comes with relying too heavily on the performance of a single sector or asset. Diversification can help protect your portfolio from significant losses if one part of the market underperforms. In addition to diversification, staying informed about the market and broader economic trends is crucial. Paying attention to economic indicators, market trends, and the news can give you insights into how different factors might affect your investments. This knowledge allows you to make more strategic decisions, adapting your investment approach as conditions change. Moreover, adopting a long term perspective can be beneficial. While the stock market can be volatile in the short term, it has historically tended to grow over the long haul. Short term fluctuations should not necessarily derail a solid long term investment strategy. Lastly, consulting with financial experts can be invaluable. Financial advisors can offer personalized advice tailored to your specific financial situation and goals, helping you navigate the complexities of the market with more confidence. By following these strategies, individuals can approach the stock market more effectively, making decisions that are aligned with their investment objectives and risk tolerance. As we've explored today, the relationship between presidential politics and the stock market is complex and influenced by a wide array of factors. While it's tempting to draw direct correlations between political events and market performance, the reality is much more layered. Understanding the stock market requires a look beyond the headlines and a deep dive into economic fundamentals and market psychology. Remember, investing is a marathon, not a sprint. Patience, diversification, and informed decision making are key to navigating the market's waves. Thanks for tuning in to Stock Whispers. If you enjoyed this video, give us a thumbs up, subscribe, and hit that notification bell so you never miss out on our expert investing advice. Until next time, keep listening to those whispers and let them guide you to your next big win. See you soon!